That's the magic number. That's 20. So let's go ahead and get started. Greetings, everyone. I'm Jeff Sandeen. Welcome to today's webinar. I'm a certified financial planner and president of Sandeen Strategies, a wealth management and financial planning company. And I'm also founder of Business Pro, producer of today's webinar titled Thriving Business Value, a Marketplace Perspective for Owners. The webinar features Tom Bronson, Larry Lane, and Dan Vermeyer, who you'll meet in greater detail in a couple of minutes. Business Pros is an alliance of business professionals collaborating to bring high-quality educational content to entrepreneurs, business owners, and executives, as well as support each other's business development efforts. Our mission is helping you win at business. Here's how today's webinar will be structured. Our panelists will each introduce themselves, and then Tom will make a short presentation and we'll proceed to an interactive dialogue. During the dialogue, if you have a question, type it into the chat box. The chat function is displayed when you hover over the bottom of your Zoom screen and just click on that. Type in your question. We'll answer those questions towards the end of the conversation. Lastly, today's webinar will come. So you can bring yours up.
Oh, awesome. There we go. Jeff, you were breaking up quite a bit there. So I'm just going to remind folks, hopefully you can see my screen. It's gold lettering, black background. Everybody can see that? Awesome. So I'm just going to remind folks, because you were breaking up a little bit there in the introduction, Jeff, that we are taking questions. Feel free to put your questions in the chat while we go, and Jeff will interrupt us where appropriate, and we will jump in and answer your questions. But we'll also take questions at the end, and we're hoping that everybody stays for Tom Allen's questions at the end. So let's get started. Today we're talking about driving business value, a marketplace perspective for business owners. And let's see, my screen is now trying to go to that. Give me 1 second here. Let me start this again. There we go. And we're going to our next slide. There we go. Well, so we've got 3 panelists today. I'm Tom Bronson with Mastery Partners. Let me allow we've got Larry Lane from VR Business Brokers and Dan Vermeyer from CFA. Larry Lane, why don't you introduce yourself, and then we'll go to Dan.
Sure, thanks. Good morning, everyone. My name is Larry Lane. My company is VR Business Brokers. I'm part of the National Franchise Organization. I own the Dallas area office for VR. VR has approximately 50 offices across the country. Our business is helping owners sell their business when they're ready to exit. We're typically dealing with small privately held companies. Typically our revenue threshold is up to about 10 million. We're fairly industry agnostic. We deal with all types of industries, everything from manufacturing, service, construction, retail, franchise, and independent. So we pretty much cover the gamut when it comes to business types. And most of our business activity is in the North Texas region. We do have listings throughout the state, and in some rare cases outside the state, but the bulk of our client base is in the Dallas, Fort Worth, North Texas region.
Awesome. Thanks, Larry. And Dan Vermeyer with CFA. Dan, would you introduce yourself, please?
Yeah, good morning. I'm Dan Vermeyer with CFA. We're a global investment banking firm. We focus on representing companies from about 10 million up to 250 in revenue. Our process involves making a market for those businesses by developing a marketing package about the company, researching the industry, finding likely buyers, and then reaching out to them on a confidential basis to invite them to learn about the business and make a proposal.
Awesome. Thanks, Dan. Good to have you with us as well. I'm Tom Bronson. I'm president of Mastery Partners. We are a consulting firm that typically works with business owners before they go to someone like Larry or Dan. We're not an investment banker or a business broker. What we do is prepare business owners for that eventual transition. From the lessons that we've learned, I have personally participated in 100 business transactions, either buying or selling business. So we bring our expertise to the market as we think about helping business owners prepare for that ultimate exit. So I want to start with just a thought here that and my screen is now going really slow. It may be because I'm a co-presenter, Jeff. 100% of every business in America is going to transition. That's the premise for today. Every business will ultimately transition. Whether you work for GE that transitioned when Jack Welch retired and Jeffrey Immelt took over, that transition, by the way, took 7 years to plan. Business owners can learn from that because every business will ultimately transition. So, unfortunately, though, of the landscape of business owners out there today, 74% of all business owners have no transition strategy in place. And so we want to talk about some of the things that they should be thinking about. One of the reasons that they don't have anything in place is that this is a once in a lifetime opportunity for almost all business owners. Most people aren't like me. They haven't been a serial entrepreneur and bought and sold a bunch of businesses through their career. This is a once in a lifetime event. A lot of times their life is completely intertwined with their business, and they feel like their business is their life. And so I want to give just a little bit of the landscape of what business looks like in America today. This chart shows it's a little bit dated, but the numbers haven't changed that much. There's about 6.1 million businesses in America that employ people. Now, there's another 22 million businesses that are solopreneurs or independent contractors or whatever, but there's 6.1 million businesses in America that employ people. Of those, close to 99 or 99.7% of those businesses are less than 100 million in revenue. 99.7% of businesses in America that employ people are less than 100 million in revenue. 99.7. That is an amazing number of businesses. Each year, of those businesses that are less than 100 million in revenue, about 4% of them come on the market. About 250,000 businesses put themselves on the market either by force, that they have to, that they're dealing with death or divorce or disablement or whatever it is. Some of them do it by choice, of course. But out of that 250,000 that come on the market, only 17%, 42,500 of them actually close a transaction. That is an alarming stat. That means 83% of businesses that attempt a transaction fail to actually complete that transaction. And frankly, that's what we're on a mission to fix. And that's what we're going to be talking about today. I'm going to stop sharing so we can, maybe my computer will speed up just a little bit here. And I want to talk with, of course, Dan and Larry about the current landscape. So guys, let's start with you, Larry, and then we'll go to Dan on this question. How are businesses valued? Is there some sort of a formula that tells us how businesses are valued today?
Well, yeah, there are metrics. Most people would associate business value with a multiple of earnings as the quote formula. Now, what that multiple is and how you actually assess the earnings, that will vary from from people to people on their approach. But in general, yes, you have a multiple, which is a multiple of earnings, and that multiple varies by industry, varies by size of businesses or size of business, and varies depending on the state of the business. There are other factors other than just the raw earnings that can determine what the value of the business is.
Well, that's a lot of ifs, and it depends. Dan, can you give us a more clear answer? How, how do you value a business, Dan? Give me the formula. We want to know.
Well, that's right. There are a lot of variables. I think one key to keep in mind is that as people look at a business initially, they're going to value it in a range. You know, they're going to say, oh, that's a 5 to 6 times EBITDA or 2 to 3 times revenue. You know, some general range that will vary a lot by industry, by that point in time, you know, and then as they dig in deeper, that business will be valued at the higher end of that range or the lower end of that range, depending on what kind of quality is in the business.
So you're not giving me a good formula either. I don't like
Nope.
either one of you guys anymore.
It's
So
just not that easy, Tom.
I know, I know that. Now, do to either one of you, in your experience, do most business owners have a realistic opinion of the value of their business?
It's a pretty broad mix. Some business owners think their business is worth $30 million because they have 3 daughters and they want to leave each of them $10 million. And the business may not have anything to do with that. Other cases, business owners don't understand the value of their business. I've had the honor recently of giving a couple of business owners the good news that their business was worth maybe twice what they thought it was. And we're off to the races, you know. So no, I don't think business owners have a very good idea of what their business is really worth.
And I think part of the challenge to that is, Larry, did you want to jump in on that question as well?
Well, I just wanted to stress the point that I think one of the best things owners can do is, whether they're a year away from thinking they want to go on the market or 5 years away or even 10, occasionally get a business valuation done so that you can have a realistic idea of what your business is worth, and also see the dynamics as your business changes, how that value is changing. If you own your business 20 years and wait till the 20th to decide you need to find out what it's worth, I think you've done yourself a big disservice.
Yeah, I think, you know, and that's, I mean, really and genuinely, we joke here, but the truth is it depends, right? There are so many different ways to value a business. I would say that of the smaller transactions, Larry, would you agree that in smaller transactions, most of them are traded on a multiple of earnings, or EBITDA, or owner's cash flow? Is that a fair statement?
That's correct. Right.
And Dan, in bigger transactions, it might involve some other intangibles. Now, it could in the smaller transactions as well, but Dan, it could include some additional intangibles. Would you agree with that?
Yeah, a lot of things can push that value up or bring it down, you know, and a lot of it has to do with, you know, how stable has that business been? Has it been growing? Do they have a good management team? Are all the lights on? Is it a clean business? You know, lots and lots of factors inside of the business.
Yeah, that's those are great points. So the challenge then to our audience today, the folks here joined on this webinar, is that there's no easy way, no quick formula to just figure out what a business is worth. And the challenge is not all transactions are reported somewhere. It's very difficult to find good statistics on business transactions. There are some resources for it, and many firms, like I'm certain Dan's does, pays many thousands of dollars to gather as much data as they can to be able to understand how various businesses are trading. But the problem is with business owners, they get anecdotal information. The stuff that typically hits the press, the stuff that you read about in the Wall Street Journal, where this, you know, $1 million startup sold to Google for $1 billion, or more recently, I've got a friend that sold his business, a $10 million business, to Google for $162 million. Those are anecdotes, and most businesses are not trading on that. That is because they have some disruptive technology, perhaps, or some disruptive products that somebody wants, and that drives that valuation up. but rank and file, almost every other business in America is going to trade on some multiple of earnings, or depending on the industry that you're in. So let's start with you, Dan. You just mentioned a couple of these things. What are some of the primary drivers of business value?
Well, Tom, some of those primary drivers are outside of the business owner's control. They have to do with the state of the economy or the industry that they're in, or interest rates and how aggressive banks are into lending into those deals, or how much cash is on the sidelines with the buyers and so forth. So a lot of things outside of your control, but the things that are in your control, obviously revenue and earnings, growth rate, things like that, keeping your eye on the ball, running a good business, having a good management team, having a good business plan that everybody signs up to and everybody is marching on the same path. Things like that are really important in driving business value.
What about you, Larry? Same question. What are some of the primary drivers of business value that you see?
Yeah, I think Dan hit on a good number of them. I would say keeping your business current, automation, invest in your equipment. If you use equipment in your business, keep that fairly current so that a buyer looking at it doesn't say, well, they've got a completely obsolete, facility. I'm going to have to invest a lot of money on the capital side to bring it up to date. So keeping it current in that regard. I think depending on your type of business, customer diversity can be important. If you've got all of your business in one or two customers, that's going to really depress the value that most buyers would put on the business, because they're scared of that. They're scared of that customer or two leaving, and that kind of falls into that whole diversity of management team that Dan mentioned as well. A lot, even small businesses, it's really important to have a cohesive group, to have some good tenure within your employees. The more turnover you have in that regard, for a buyer, it's a little bit nervous to come into a business that nobody's been there more than 6 months or something like that. So those are all the things that can affect you in that range. Dan talked about, even with multiples, you have a range of value. The more checks you have on these items that we're mentioning, the higher you're going to be towards the end of that range. The less checks you've got, the lower you're going to be on that range, if even dropping below the norms.
Well, you bring up a couple of important hot buttons there, both of you. Certainly that customer concentration issue. I recently talked with a prospective client that basically 80% of their business was with one customer. Now, it's a good, stable customer, but that makes a challenge when it comes to a transferable business. To me, and culture, by the way, we overlook culture. Culture is one of those intangible things that does improve value of the business. That makes the business more attractive. Now, it might not add, another factor onto the multiple, but it will make it more desirable. And the more desirable the business is, typically the higher the valuation. So culture is a biggie. A couple of other ones that I don't think that you guys mentioned, especially for the small businesses, are what we call owner dependency. If the business is super dependent on the owner, now that's typically in smaller businesses. When you get into kind of that lower middle market, 20 million and above, it's typically less than that. But I've seen businesses that are 50 or 60 million dollars that still depend completely on the owner. The way I like to look at that, if a business is 100% dependent on the owner, it's almost worth zero, right? Because if you take the owner out of the equation and the business can't operate, then that is a huge detractor in business value. The last thing I wanted to mention there is documenting processes. Now, that sounds like a silly thing, why would you care about documenting your processes? Well, let me give you an example. Now, by the way, in every business, you might have 400 or 500 or 600 or 800 processes that you go through. I'm not talking about documenting everything, but I'm talking about documenting the most important things that drive the business, and going through a process to identify those most important processes that need to be documented. It makes the business more transferable. It makes it easier to hire people. It makes It makes it easier to train people when you document those processes. And I actually saw an example one time of a business the industry was trading at 6 to 8 times the earnings, but a company got a 22 multiple on their earnings because they were being bought by a bigger company who wanted to implement their processes in the organization. So don't overlook kind of some of the operational things that might also drive business value. So do values change over time? Larry, let's start with you on that.
Well, yes, they can change over time. I mean, again, values are sort of driven by earnings. So as earnings change, values will change. But as far as the process of determining a value, in most cases, it's a fairly consistent. A good example where things may be a little different would be where we're at right now with COVID. So, that's obviously having an impact on how values are changing, or how to determine what the real value may be based on the impact. But in general, in my opinion, it's a factor of the multiples. Good economic times will drive the multiples a little higher. Anytime you have a bigger buyer pool, you get that. And so that will change it. Economy recedes, that can depress the value, but typically it's again being driven by the earnings. If the earnings are depressed, then obviously the value is going to go down. So the method is pretty much the same, but the value obviously dips and peaks and valleys with the earnings.
Right. Dan, what about you? Do you agree with that? Do valuations change over time?
Yeah, valuations definitely change over time. And some of that's driven by those external factors that we talked about, and primarily the interest rate. Interest rates are as low as they've ever been right now, but contrast that back to, 2009, 2010, you almost couldn't give a business away at that point. Same business, doing the same revenue, having the same earnings right now is worth 25% more than it was then, just simply because of the liquidity that's out there, the bank's willingness to lend into transactions, the cash that the buyers have and so forth. All of that's fuel to the fire that creates higher valuations, So a lot of the timing, obviously if the business grows or it gets to be a more profitable business or has a better management team over time, sure, its value is going to go up. But the bigger influences like the tide going in and out are interest rates and the willingness of banks to lend into transactions.
So I agree with all the points made. The only caveat that I would give is that sometimes markets start trading a little bit differently. So, for example, let's say that you've got a fast food franchise that becomes a hot topic, that suddenly the multiples on those go up to, normally they've been in the 7 or 8 times range, and suddenly they go up to 11. Why? Because there's fewer opportunities available and it drives the price higher. It's kind of like supply and demand. But also I've been in businesses where the market changed, that we're trading on a multiple of recurring revenue at a very high multiple of recurring revenue. That multiple came down as there were more and more sellers than there were buyers, and ultimately you had to pivot to a different strategy in order to sell that business. So I've seen valuations change and fluctuate even based on what's going on in the market. So what should we've talked about the intangibles and some of those other things. Dan, let's start with you. What do you think business owners should be doing to drive value?
Well, I think the biggest thing really is to be proactive. It always bothers me when I get a phone call from a business owner and they say, hey, something happened in my life, or somebody called me up, wants to buy my business. I want to react. I want to sell. I want to do that. that's no plan, that's no preparation, that's terrible. So be proactive, have a plan, run a process that's on your terms, where you have control, you have leverage, where you, bring multiple buyers into the process at the same time. But if you can be proactive, let's say 2 or 3 years even before that, and start thinking about, I might want to sell, in 2 years, or I need to get a transition plan figured out over the next 2 years. So form a team, hire Tom Bronson. And if Tom's real busy, maybe Tom can refer somebody, I guess.
I love that advice. I think I think that may be the best advice. Okay, we're done. Questions? No, I'm just kidding.
So, get started and make a plan and do it on your terms. So many things can be so much better if you're being proactive rather than reactive.
What about you, Larry?
Yeah, well, I'm totally on board with that. We see the same issue. People wait till the last minute, or they never really have a plan. I met with an owner first of this year who's 75 years old and told me point blank he never intended to sell his business and never planned for it. And he had a nice business. I mean, he made a nice living out of the business, but it was, as you talked about earlier, it was him. I mean, he had no infrastructure, he had no support, he had all the customer relations. So, if he'd have planned even 5 years before, he could have really improved the value of that business, because again, it's a nice business. So I'm totally on board with the planning. I think that, really you plan to sell the business the day you buy the business. Now, what that timeline is will vary person to person, but it's really all part of it. One thing we haven't hit on too, that I think a lot of people, especially the smaller business owners that we tend to deal a lot with, they live out of the business. And so their financials reflect that. That's not creating good value for that business to sell it. So that timeline, 3 to 5 years out, start, cleaning up your books. Even if you have to pay Uncle Sam a little more, that's going to improve the value of the business. And that multiple is going to earn you a lot more when you sell the business than the taxes you might have paid on some of those earnings that you had in there. So, that's all part of the planning process, but clean up the books at least 2 or 3 years out so that it's what a buyer would want to see. If you're saying it makes $300,000, that's what it needs to show that it makes.
You said a mouthful with you should really plan the day you open the business to what your exit strategy is. I'm a big fan of Carl Allen, and he says the only reason to own or to start a business is to be able to monetize it later, sell it and monetize it later. And I agree with that. All of the businesses that I've been in, I've always been able to articulate my exit strategy from the very beginning. I never got into a business without first understanding what my exit strategy was. And of course, I recognize that I'm in the minority when it comes to that. Now, another thing that I might include for a business owner to start thinking about is planning for unplanned disasters, right? Think about what happens if something happens to one of your key people. I had a good example of that. I had a relatively small company here. Our chief operating officer was my right-hand guy. I mean, he ran the operation. I got a call at 1:30 in the morning one time from his wife, and he'd had a massive heart attack. Boy, suddenly I went, oh my gosh, we haven't planned for what happens. Of course I was worried about him, but what happens in this event? So it launched us into thinking about what happens in case of a disaster. What happens if we lose that big customer? What happens if we lose a key employee? What happens if I, as the business owner, get disabled or get hit by a bus on my way home? What happens to the business? So I think thinking about that strategically long in advance will help you really think about those things and be able to deal with them, so that when you don't wake up one morning and suddenly decide it's time to sell the business, you've actually thought through some of those things in advance that might happen. And so I've heard all kinds of reasons for business owners to decide to sell their business, illness of a spouse, or their own illness. I actually heard recently a business owner decided to sell his business because his dog died, and his dog was his 17-year companion at the business. Was with him basically all the time. Well, that's an unusual circumstance, but then is the business ready to sell? You really need to plan. The biggest thing I think a takeaway here is plan this in advance. Because if you call Dan or Larry or myself or any one of the number of folks that do what we do, and you've decided I need to sell this right now, well, the chances are you're not going to be able to maximize the value of that business because you haven't planned it in advance. So in order to get the best valuation, should a business owner invest in marketing and R&D and grow the business, or should they control expenses and maximize profits? Let's start with you on that one, Dan.
Well, the fact is most buyers are pretty sophisticated, and if you're overdoing it in some area, like heavy into R&D and no profitability, a good representative like me can show the buyer that, and they do the adjustments for that and spread that investment out over time and give you credit for it. Likewise, if you don't do any investments in R&D or marketing or sales, and you're just maximizing profits that 1 year, buyers see that and they realize you're running too thin, and they give you a reverse add back for that and kind of assume that profitability is not sustainable. So the key is you should run the business. Strike a balance, keep running the business, keep the eye on the ball, keep it a healthy business. And if you try to squeeze all the profits out of it, that'll be obvious. And likewise, if you just make a huge R&D investment, people will give you credit for that as well. So you get credit either way.
Right. What about you, Larry?
Yeah, I have always preached to people, keep running the business as normal, even while we're on the market. So run it as normal up till we go to market, and keep the same mentality while we're on the market, because you never know how long it's going to take to get a deal done. Generally, when it comes to maybe new equipment investment or something like that, I'm typically advising people that you really, again, needs to be part of that longer term plan. So if you go buy a brand new piece of equipment that you really didn't need, and you're not, it's an investment because you think you're going to grow the business with that investment, then you need to give your business a little time to show that growth is there to justify that investment. A buyer will be a little more skeptical to give full value for that brand new piece of investment if it was really to grow and not to replace a needed piece of equipment. So don't necessarily say don't do it, but just plan accordingly, that really what you should be doing is investing for growth. And that's part of your strategy for exiting, is when you're peaking that growth. That's the way I would advise on that. From a marketing perspective, always keep the marketing going, because if the marketing was driving the revenue to begin with, if you pull back on that, you've run the risk of really hurting your business from a revenue standpoint. So always keep the marketing going. Maybe not some brand new, expenditure that's not been part of your business mix in the past. Again, unless you're assuming that's going to lead to growth, and a year, 18 months from now, you've got the proof in the pudding to show that was worthwhile. But hardly ever do I see reason for pulling back on marketing at all.
And if you're going to make some changes, I wanted to point up more what Dan said. If you have anomalies, so suddenly you went from 10% bottom line to to 25% bottom line for a quarter or two, most buyers are going to look at that as an anomaly. You need to have a trailing 12 months at a minimum. You know, it's best to be able to look at your business on a 3-year trajectory. But buyers are skeptical of a hockey stick, right? So you've got to have some time in there to do that. And in terms of the way I think about balancing expenses versus growth, we used to use, and in the software industry, you find this a lot, and you'd have to benchmark the industry that you're in or that you're talking to. But we used to have what we call the rule of 40, which many of you may have heard of. That is the combination of your growth and your profitability, your EBITDA. You add those together. Let's say you're 20% growth and you're 20% EBITDA. That means you hit 40. That's the rule of 40. That's what you want to hit. If you can get north of 40, that's awesome. So in software companies, that's kind of the way we looked. But what happens there, it's okay for that teeter-totter or the pendulum to swing one way or the other. If you've got more than 40% growth, the assumption is you're reinvesting rather than being profitable. And so it's okay to have north of 40% growth if you're basically break even, and that still will be a valuable business. On the other hand, if you have no growth, if you've been flat for a few years, then you better be driving the highest percentage to the bottom line. That means if you've got a 0% growth, then you need to be driving 40%. So that's a good benchmark in the software space, but you can talk with folks and learn what the benchmarks are in your space. I think that's a great way of the way we think about it as we think about those values. So how can a business owner get a premium value in the M&A process?
Well, we kind of think of that in two ways. One is just presenting the accounting properly, and the other is in the process itself. From an accounting perspective, understand that net income doesn't really mean anything. That's kind of a number for tax purposes. But we always figure out EBITDA and then adjustments to EBITDA. So, over market compensation or expenses that you run through the business that aren't really for the business. You want to wind up presenting the business with what the new owner would expect in terms of earnings. Trying to differentiate that, be clean on that. I know business owners that carry two different credit cards. One is for expenses that truly are business expenses, and the other one is expenses that are really personal expenses, even though they're all still paid for by the business. At least that way, it's very easy for us to show what is a non-business expense, what's over market compensation, things like that. And then when are we talking about? A lot of buyers want to talk about the average of the last 3 years of earnings. I always try to present the business at some point in the future, because this process is going to take a while, 6 months maybe. And so I want to present, if the business is growing a little bit, I want to capture that growth in the numbers that I'm presenting. So we'll say, their trailing 12 EBITDA at the end of June is going to be X. And, we may be just in February or March at that time. And as long as the business gets there, at least we're pricing it on a little higher number than we would have otherwise. From a process perspective, again, you want to be proactive. You want to have a controlled process where you have the leverage to manage multiple buyers against each other. But you want to get a little bit of an auction effect going on here, a little bit of competition for the deal. And you want those buyers to know that, so they're going to put their very best foot forward. And you're going to get, say, 15 to 20% higher value than if you just took a phone call one day and some guy offered you a number for your business. If you run a good process, you should easily get 15 to 20% higher than the run-of-the-mill valuation that you get from a pedestrian.
I think having multiple bidders, kind of like a bidding war on a home, right? If you have multiple bidders, it drives it up. Do you get that with the smaller businesses, Larry?
It's not as common. It's a lot more of a challenge to drive multiple buyers to the table at the same time. That's not to say it can't be done. It doesn't occasionally happen, but we don't prep sellers to anticipate that. We're packaging a deal. We're telling the sellers it's going to take, probably a year to get a deal done, depending on how we've priced it, how aggressively we've priced it, or how aggressive we're looking at the future, as Dan commented on in our pricing. So, we've got a price range. We've put it on the market. We're marketing it as heavily as we can. We get a buyer to the table. If we can get multiple buyers to the table at the same time and get in that auction atmosphere, great. But if we get the right buyer to the table in the price range that we know is there, then we need to be ready to take advantage of that buyer.
So I think the message to our listeners today, our viewers today, is that that the bigger the business, the more likely you can get into the multiple bidders, and the smaller the business, the less likely. And so it is important to drive value that you do continue to grow your business and kind of cross that threshold where you might attract bigger buyers that might have more interest. So you mentioned, Larry, that it could take a year or more. What is the timeline? How long does it take typically to sell a business?
Well, for the databases that we look at, statistical databases on business transactions, the running average is about 7 months. That's from time it goes on the market till you've got a contract. It's actually a little higher right now. In fact, I just looked yesterday to see what the timelines are extending out. We're now closer to 8 months. And so the timeline's been extended. That's why we tell people plan on the year. Some deals are going to happen a lot quicker. Sometimes you just hit it, just right. And you priced it right. The right person was looking. The two parties hit it off, which is always going to make it an easier transaction, and you can get it done quicker. Other times, you priced it on the high end. You knew going out to market at that high end, it was going to take longer. We're all okay with that. So, we'll kiss a few frogs along the way and expect it to take longer. The other thing you got to keep in mind too is the financing side can always muddy the water there. And right now, again, in our current climate, financing is not as cut and dry as it was, a year ago. So you got to plan for that to take, it can take 90, 120 days. We've got one deal out there that we're over 120 days still waiting for an actual decision from the bank.
Wow.
So, yeah.
I've got a few bankers.
I think taking that long has pretty much given us our answer. They just haven't formalized it yet.
Right. Yeah, I tend to agree with that. So what's the shortest time frame you've ever seen, Larry? What's the fastest you've ever closed a transaction?
To be under contract, 30 days.
Wow.
Now that was such a rarity. That's out of over 120 transactions. So, don't any owner out there think that is realistic. I would tell anybody that's not realistic, but it just happened to hit just right. It still took another about 45 days to get it closed. So
that's still incredibly quick, 75 days.
That is such a outlier. I've also had deals take the longest listing I ever had that we actually did get sold was just right at 3.5 years.
Wow.
Took that long.
Yeah, that's it. So, Dan, and the businesses that you work with, so what is the timeline for a sale there? How long does it take?
Similar, generally longer. The process itself to get to the point of an LOI and have a relationship with the buyer is probably about 3 months, maybe 4. But then to get these closed, when you have a private equity fund involved or a couple of banks involved and all the different contracted efforts that come into play there, that's easily another 3 months or 4. So, it can be 6, 9 months, maybe a year. But just circling back to that idea of planning, we talk about getting all the moons to line up, being a good time in the market, being a good time in the economy, in a good time in your business and your competitors and whatnot. But having your act together as a business owner and you're ready, and the buyers can see that, if you're doing that kind of planning, you'll see the good window of opportunity coming along and be ready for it. And the whole process can go a lot faster. It's when the process really stretches out is when a seller hasn't done any planning and there's just too many gotchas along the way and bad timing in the market or whatnot. And in some cases are forced to sell rather than doing it according to a plan. And so obviously their planning can make a big difference.
Yeah, the fastest I was ever able to buy a business was about 15 days from, actually, no, that's wrong. I just thought of another one in the technology space where I was at. I did that one in less than a week, but it was a distress sale and we needed to save those customers before they went away. And of course I didn't pay a lot for that.
Yeah.
So that was a very quick and a distress situation. Right before that business went bankrupt, right? So we were able to pull it out and save the business. But the longest, yes.
We have some questions up in the queue. Just let me know when you're ready to go.
Yeah, let me ask one more question. Maybe a quick short answer on that. Then to both. Let's start with you, Dan. Can you time the market? I mean, should you be trying to time the market?
Very difficult. Process takes so long, 3 months, 6 months, 9 months. How do you time anything that point in the future, so very, very difficult. I think the key is to plan, to be ready, to be, all dressed up as best you can, and you get out into the market, and if for some reason things go sour, you pull back. You wait 6 months or a year and do it again, You always have that safety valve if you need it, but it's very, very difficult to time the market.
What about you, Larry? Are you a believer in market timing?
Not at all. It's a process. One thing I did want to mention about just preparation. Make sure you get tax advice and wealth planning advice. A lot of people, they think their business is their retirement, and in some cases it may very well be. But if they haven't had business valuations done and they really don't know the value, to think that that's going to be their retirement, they need additional advice to plan properly on that. And they need to know what the tax ramifications are. I don't profess to be a tax advisor at all. That's what we have tax advisors for. You got to have the right professionals advising you in the right areas of the transaction.
I agree. In fact, let me just tick off for you. I think every business owner should have what I call a transition team, a team of folks that are working with them to help them understand all facets of a transaction. That team needs to include an investment banker or a business broker, probably a value advisor, someone who advises on how to improve the long-term value of the business. You need a transaction attorney. Not all attorneys deal with transactions. I know that there are a couple actually in the room here that deal with transactions. You need a good transaction attorney. You probably need a good estate planning attorney, depending on the size of the transaction. You always need a good CPA, and not just a CPA who does the taxes every year or does your books. I'm talking about somebody who understands the tax ramifications of doing a transaction. You probably need an insurance person. Who am I forgetting here, guys? Is there somebody else that I'm forgetting in this?
How about a financial advisor, Tom?
Oh, there you go. I knew Jeff would speak right up. So you need to have a good, solid financial advisor. But you got to assemble a team that can all work together on this in your best interest to maximize value. So with that, Jeff, the financial advisor, let me take a question or two.
So this one's for Larry and Dan. What do you advise prospective clients who come to you to sell their business, but they didn't plan ahead? Is there anything they can do at the last minute to benefit their business? And is there anything that that you might send them over to somebody like Tom to get done at the last minute?
Well, you want me to take that first?
Sure.
Yeah, go ahead.
Okay, so last minute obviously is not ideal. And I mean, Tom needs time to have impact. So if you're willing to, then turn around and give it time, then obviously somebody like Tom who can help plan properly for an exit strategy down the road, that's the ideal scenario. If you've got to sell the business today and there's been no planning in the process, obviously we can give you guidance depending on the status of the business as to what the next best steps are. That will vary from deal to deal. I mean, if you're trying to sell it today and your books are a mess, we got an issue. If you're trying to sell it today and your books were still pretty clean, it's still going to take time, but we can at least go to market right away. So it really depends on some of the other elements, whether they're in place or not, as to whether there's reason to go to market or not. I mean, in some cases, we tell people, unfortunately, we're not in a position to be able to help you because there's just not anything there to give us time to do. If you're looking at you're going to file bankruptcy in 2 weeks, we're not going to be able to sell your business in 2 weeks, even though Tom might buy it in 7 days. I wouldn't bet on that.
No,
Well-
that was just a happenstance, right? Dan, why don't you jump in on that?
Yeah, in my view, obviously everybody could benefit from working with Tom Bronson, but sometimes a business owner comes along and they woke up that day and they want to sell their business. They've been kind of thinking about it a while, but now they're serious. And so, the very first step for me is to really understand their motivation, understand what they're thinking about. And if they don't care about getting more money out of the business and they don't care about exit planning and they just want to get the deal going and get it sold, then I'm going to go sell that business,
Yeah.
And I can give them honest advice and I can tell them what I think the low-hanging fruit is from my view, or what I can try to get them to sit through a lunch with Tom. It's scary, but if they don't want to do that and I'm just pissing them off by suggesting these, what they view as a tangent or a side thing, then we're not going to go there. We're going to get engaged and we're going to sell the business and they'll leave some money on the table. On the other hand, there's a lot of buyers that like that. They like seeing a business that's got some meat on the bones, some things they can do to improve it. So, it really varies, but it's got to begin with what that business owner is thinking about and what he would like to do.
Yeah, I'd like to jump in on that. Thanks for the compliment there. But the reality is that if value is not the big driver, it doesn't matter. That's fine.
Right.
If you're ready to sell, then go off and sell it. But if you need long-term value or generational value out of the business, then you need to be thinking about this farther in advance. And I agree with that. Jeff, any other questions that we have?
Yeah, how about addressing selling to a competitor? Is that sometimes a lucrative way to go?
I have actually been a buyer as a competitor sometimes and considered selling some businesses to a competitor. My advice on that is have a really, really good general counsel, corporate attorney / transaction attorney, because you need to protect your information and you need to have a way to make sure that during due diligence that you're not giving away all of the information that can then be used against you. So you need to have an ironclad NDA that if this deal falls apart, that they can't use that, and there's ways to deal with that legally. So I would say proceed with caution, but it is a viable method, and the biggest champion you can have on your side is a really, really solid attorney to help with that. You guys, any other answer on that?
Yeah, my answer on that is, in most cases, competitors are not the right buyer unless there's a good reason. Maybe there's a geographic difference or some sort of a product line difference, where they really are synergistic together. But and it's funny how most business owners think of a competitor as the likely buyer. But my best value to them is if they come along and say, yeah, I think this competitor would be a good buyer. First thing I'm going to do is go find 2 or 3 other buyers and give them something to compare it against. then have a deal sort of on the table, somewhat ready to go, then go to that competitor and say, hey, we'll give you about 2 weeks here to look at this. And if you're truly interested, we can engage. But if not, we have another deal, another bird in the hand to go with. And you don't give them enough time to hurt you if they are so inclined. So
Yeah.
I think the best choice here is to go get some options and then bring in that competitor later in the process.
The alternate side of that, though, is also in a roll up. If you're in an industry that's experiencing a roll up, then the company that's doing a roll up, I've done 2 massive roll ups. Then the buyer may pay a premium, even though they're competitive with you, and so that would be the only exception to that. Jeff, what else do we have?
Here's one from Tom Allen.
Uh-oh. Should we open his microphone and let him ask it directly?
Ask it, Tom.
And this isn't the questions that I had for you, but it is another one. But should the owners actually plan on hanging around for a while? Because I've kind of seen it both ways.
What about Larry? Why don't you take that first, and then Dan?
Yeah, for most businesses, my view is that if you can have the owner around, at least as an option, that's always a plus. We find that in some businesses, some business transactions, we had that agreement. Deal gets done. It ends up being a lot shorter timeline than was agreed to, that they decide it's not necessary to stick around. There's always some element of challenge. New owner likes to run things a certain way. Past owner had their way of doing things. How easy can that coexist for a while? But in most cases, I would say certainly plan on a transition time, even if it's a short window. But if you're willing to put yourself out there to stay, that's always a plus.
Right. What about you, Dan?
Yeah, part of it depends on how the owner has positioned himself up to that point. If he's got a good management team in place and he's extracted himself from the business somewhat and is kind of just the majority shareholder at that point, then it's pretty easy to take him out and he doesn't need to stay around too long. Other cases, he is somewhat integral or the buyer is worried about that, which is really the majority of the cases. And he needs a plan to be there for quite a while. In fact, most deal structures will kind of incentivize him to stay with an earn out or some sort of ongoing shareholder position. So most cases, a business owner needs to stay for a while, year, 2. If he's going to roll a lot of equity in and keep leading the business, it could be indefinite, but he needs to plan to stay until more or less he's worked himself out of a job.
I've got a great example of that, and then we'll allow folks to walk off if you need to, because we're coming right up to our appointed time. I almost derailed an acquisition of one of my companies because I was not staying, and I was one of the folks that the acquiring business wanted. And I almost derailed it because I told him I had no intention of staying, that I would work on a transition, but that I didn't want to stay longer, because I've learned 2 things about myself. I'm a great CEO and I'm a terrible employee. And so I knew I didn't want to go forward with the transaction, even though I had built out a team that could handle everything beyond that. I almost queered that deal. And so you got to handle that very delicately. So we are at the end of our time. If you need to jump off, totally fine. But Jeff, can we stay on and answer any questions that somebody else has?
I say as long as you're willing to stay, we can do that. There'll be more questions, and then these guys will wrap up and I'll close it. But typically we might go 5 to 10 more minutes. So if you can stay along and you'll learn more.
Awesome. I've got a hard stop in 10 because I've got a client that I need to go visit with. So what are some of the other questions we have, Jeff?
Michael Beje, do you want to open up your microphone and ask your question?
Oh, I just, in hearing Dan's response, I just wanted to kind of bring up, why don't, if Dan, you want to take it, or Larry, just talk about the challenges of structuring an earnout based on an EBITDA threshold as far as future disputes and challenges that will arise because of that.
Yeah, so earnouts are a big part of our life, especially since COVID. People want to have a little bit of assurance that the business will continue to at least at an even keel or grow, and that COVID won't pop up and affect it in some way or other things too. So you see a lot of earnouts right now, kind of basic. Earnouts are tricky. You know, if you're going to have an earnout, ideally it's on revenue, high up in the income statement. The lower you go in the income statement, the more potential there is for some conflict, because theoretically the new owner owns the business and can direct it, but here's this seller that is still dependent on how the business performs for his earnout, and all kinds of new expenses could come along that'll affect earnings. You know, they might hire more salespeople, they may do this and that. So normally what you see contractually is either some information, you know, some language saying that the certain things will not be included in the EBITDA calculation for purposes of the earnout. If the new owner doesn't agree or they can't agree on it, you know, certain things will be excluded from that earnout calculation. Other things I've seen is where literally the buyer had a positive obligation in the purchase agreement to help that seller make the earnout. The buyer had the obligation to help do whatever needed to be done to help him achieve the earnout. That's pretty rare to get that, but you can imagine those kinds of conflicts that would come up in that deal.
I wanted to tag on to that. A great friend of mine and friend to some of you on this call, a local serial entrepreneur, Jay Rogers, always says that if you are not happy with what you're going to get at closing, don't do the deal. Earnouts almost never work out exactly the way you think they are going to. And so if you are not happy getting 0 in the earnout, then don't do the deal and be prepared. I've seen earnouts and I've given earnouts. Some have been paid, some haven't been paid, and it's based on the structure of it. But I love that advice that if it's not just a payment plan and a payment structure and it's an earnout, if you're not happy with what you get at closing, don't do the deal. I see Dave Casey shaking his head. I know he's heard the same thing.
Yeah, we used to say that the deal is like a cake and cash at closing is the cake and the earnout is the icing, you know, but don't pay attention to the icing. Better go for the cake.
Exactly.
So there are no more questions in chat. You guys want to just go around the horn and wrap it up, each of you with some final comments, and then we'll close her down.
Dan, we'll start with you, then Larry, then I'll take the tail end.
Yeah, okay. Well, I appreciate the opportunity to be here and speak, you know, and Tom, appreciate you organizing this. I know we like to make a lot of fun of Tom because he's got the easiest job in the world, but fact is, you know, if a business owner would spend a little bit of time thinking about it and being proactive and planning and getting it together before they wake up and are ready to sell, you know, that is so much better all the way around. So I think that that's, you know, fundamental here. Beyond that, if at the point we engage, again, I want them to be proactive, and we're running a process on our terms, not just waiting for the phone to ring and having a buyer walk up one day and say, I'll give you this for your business on a onesie basis, you know. So being proactive, I think, is maybe the message that I'd like to leave you with.
Awesome. Larry?
Yeah, I appreciate everyone's time and attention. I just wanted to make one comment on the earnout issue. We don't do a lot of earnouts. Typically, when we get involved with earnouts is when we're trying to make a gap, satisfy a gap between the pricing. And in a case like what we're currently dealing with COVID, and even some of the things we talked about with future planning, you know, maybe that's where the earnout comes into play. You did this investment, you think it's going to do this to the business, but we're selling it a little before this happened. And so you're kind of banking on that, and that's where the earnout can come into play. We still got a good price for where the business is today, But if the seller's convinced there's still upside, well, let's go in and maximize that upside with an earnout that the buyer would be happy to have provided if the business were at that level. So we kind of are trying to just fill a gap with the earnout side. As far as to wrap it up, yeah, plan. Please do some homework on valuations. Don't go by what your neighbor down the road sold their business for 3 years ago and think that's your business value just because they live the same lifestyle, live in the same neighborhood and all that. Get a valuation done. Don't go by some, thumb scale, multiple that we throw out in one of these meetings and think that's applicable to you. Pay someone, get a valuation done, and then update it over time.
I completely agree. If you just came in and took sound bites from this, you'd get a 22 multiple on your revenue, and you'll be able to close in less than a week.
Yeah.
Neither of those things is going to happen. So please get that out of your mind. I thank you everybody for coming. By the way, Dan, I don't have the easiest job in the world, but I do have the funnest job in the world. And therefore that does make it easy. I really do enjoy working with our clients and doing that. I really appreciate everybody coming and visiting with us today. If you have any questions for any one of us, contact information is there. I think Jeff's going to send out an email after this with contact. We are happy to talk with you and give you just insights into our experience because we do love to share with you. I hope that you've learned one or two important things about driving business value, that you really have to think about this in advance. It doesn't happen by itself. You have to think to make it happen and plan strategically to make it happen. So with that, Jeff, I turn it back over to you.
Well, thank you very much, Tom, Larry, and Dan, for sharing all this excellent knowledge. Let's give them a virtual round of applause. They did a nice job. How about that? So talking for a minute about Business Pros, our group is organized to offer high quality educational content like you saw today. Our 30 members are available to help business owners in just about any capacity. If you have any questions about the resources our group provides, please give me a call. The next in our series of webinars is coming up next month, Wednesday, October 14th. It's Funding Options for Your Business. The webinar features Sean Cass, Chris Jones of Texas Security Bank, and Rocky Lozano from Tab Bank. That's Wednesday, October 14th. Save the date. I greatly appreciate everyone staying a little extra time today. You all have a great rest of the day.
Thanks, everybody.
Thank you.
Thanks, everybody.
Nothing.